All right, CA folks, let's jump right into a chapter that seems simple but is actually a minefield for easy marks: budgets and budgetary control. Seriously, there's this one classic trap that gets so many students. But you know what? After the next few minutes, you're not going to be one of them. Let's make sure of it.
Okay, let's put you right into an exam scenario. Imagine this. Your company sets a budget to make 10,000 units. You've got all your costs planned out for materials, for labor, everything. But then, for whatever reason, you only end up producing 8,000 units. Now, the question is, can you just take the actual cost report for those 8,000 units and put it side by side with the original 10,000 unit budget to figure out how you did?
So, what's the verdict? It's a hard no. A big, fat no. And right there, that's it. That's the classic ICAI trap I'm talking about. Students who make that simple comparison end up with variances that are completely misleading, and poof, there go your marks. But hey, don't sweat it. Stick with me, and I promise you, you'll see this trick coming from a mile away and know exactly what to do.
So what's the real issue here? Well, it's pretty simple, really. You'd be comparing apples to oranges. I mean, of course the costs to make 10,000 things are going to be different from the cost to make 8,000. So a direct comparison, it's totally meaningless for figuring out if you actually controlled your costs well. So today, we're going to learn the right way to do it.
But before we can get to the solution, we've got to build our foundation. You know how it is in costing. Getting the terminology right is half the battle. So let's lock in these core definitions exactly the way the Institute wants you to know them. First up, the absolute basic. What even is a budget? Well, think of it like this. It's just a plan, but with numbers. It's a statement that looks to the future and puts a quantity, usually money, on what management hopes to achieve. It's kind of like a financial roadmap for where you're going.
Now, for your theory questions, this is the formal definition you got to know. It's from SEMA. For the exam, really focus on the key bits here. Prepared prior, that tells you it's a plan. Defined period of time, it's for a specific time frame. And attaining a given objective, it's always got a purpose. Pretty straightforward, right? Okay, so if a budget is the thing, the final document, then budgeting is the doing. It's the verb. It's the whole process of actually putting that plan together. All the meetings, the number crunching, getting the approvals, it's the action. A simple but super important distinction.
And that brings us to the big one, budgetary control. Now, this isn't just about making a plan and forgetting about it. This is about using the plan. It's an active, ongoing system. You make the budget, then you constantly check your actual results against it. When you see a difference, you figure out why and you take action to get back on track. So remember this flow: budget, then comparison, then control.
Great. So now we know what these things are. Let's get practical. How do we actually build a system for budgetary control that works? This is the framework, the actual step-by-step process that brings it all to life.
First, why even bother with all this? What's in it for the company? Well, a ton, actually. It makes managers think hard and define their goals clearly. It makes it super clear who's responsible for what, which is huge. It helps make sure you're not wasting resources. And most importantly, it gives you that benchmark, that yardstick to measure how you're actually doing.
And here's how you do it. These are the steps. You start by setting your goals, then you put the people and structure in place, you get a budget controller, you set up a budget committee with all the department heads, you decide on the time period, and then the final and really crucial step, you create something called the budget manual.
Let's zero in on that last part, because the budget manual is a really big deal. Seriously, think of it as the rule book or even the constitution for the whole budgeting game in a company. It's what keeps everyone on the same page.
And the official definition says it all. It lays out who's supposed to do what, the whole schedule, which specific forms to fill out, what reports to use, everything. Basically, it writes down the entire system so there's absolutely no confusion.
Now listen up, because this is a classic theory question. What goes inside a budget manual? For your exams, you need to know this list. It's got the objectives, a clear statement of who's responsible for what, an org chart so you know who reports to whom, a super detailed timetable, the step-by-step procedures, and even copies of all the forms everyone has to use.
But it doesn't stop there. It also explains how to report problems and the actions you're taking, how to formally revise a budget if you absolutely have to, and, this is key, it lists out all the major assumptions everyone has to work with, like the inflation rate or key exchange rates. This is so important because it makes sure everyone's plan is built on the same foundation. Don't forget this for your exams.
Just a quick word on the budget period. It's just what it sounds like. The amount of time the budget covers. Could be a year, a quarter, even just a month. There's no one right answer. It just depends on the business and how often they need to check in and control things.
Okay, so we've built the system, we've written the rulebook, now let's look at the actual tools you get to use. Budgets aren't all the same. You can slice and dice them in different ways, depending on your goal.
So you can classify budgets in 3 main ways. Based on period, like a long-term versus a short-term budget. Based on function, like a sales budget or a production budget. And here's the one we care about for our problem, based on capacity, or you could say it's flexibility.
And here we are. We've circled all the way back to that trap from the beginning. The entire solution, the key to not losing those marks, is understanding the massive difference between a fixed budget and a flexible budget.
So, a fixed budget, which you might also hear called a static budget, is exactly what it sounds like. It's rigid. It's prepared for one and only one level of activity, like our 10,000 units example, and it does not change. No matter what you actually produce, that budget stays locked in.
And this, right here, is why it's a trap. Just look at these problems. If your actual activity is different, a fixed budget is totally useless for a fair comparison. It becomes a terrible tool for control. This is exactly where those marks are lost. Comparing your actual costs for 8,000 units against a budget for 10,000 units is just wrong.
So, who's the hero of the story? The flexible budget. A flexible budget is awesome. It's dynamic. It's designed to answer the question, for the level of activity we actually achieved, what should our costs have been? And it works its magic by understanding that some costs are fixed, some are variable, and it adjusts them based on the actual output.
This comparison chart makes it crystal clear. Fixed is static, flexible is dynamic. Fixed is for one level, flexible is for any level. So the whole point, the way you solve the problem, is you use the flexible budget concept to create a new budget tailored for the 8,000 units you actually made, and then you compare your actual cost to that. Now that is a fair, meaningful, apples-to-apples comparison. That's how you ace the question.
Okay, let's kick things off with a quick exam-style question. Imagine you see this on your paper. A semi-variable cost is 1,200 rupees at 70% capacity. So what's the cost going to be at 90% capacity? Just take a second, do a quick calculation in your head. You got a number?
So, if you did a quick cross multiplication and your answer is 1,542, well, congratulations! You've just walked right into a classic ICAI exam trap. It's the most common mistake students make, and it can cost you every single mark on the question. But hey, don't worry. By the time we're done here, you'll spot this trap from a mile away and know exactly how to ace it.
We're diving straight into illustration 1 from the ICAI material. This is exactly the kind of problem you'll face, and we're going to solve it step by step so you can see how to handle these different costs and, more importantly, avoid those traps.
We're going to use a simple 4-step formula. First, we'll break down the costs into their different types. Second, we'll calculate the variable cost rates. Step 3, and listen up because this is where everyone messes up, we'll tackle those tricky semi-variable costs using the specific rules in the question. And finally, step 4, we'll bring it all together into the final budget.
So let's start with the easy part. The question tells us the total variable expenses are 1,260 rupees at 7,000 hours. So the rate per hour is just 1,260 divided by 7,000, which gives us 0.18 rupees per hour. Now this rate is golden. It doesn't change. Whether you're at 80%, 90%, or 100% capacity, you'll always use this 0.18 per hour to find your total variable cost.
Okay, red alert everyone, pay close attention. This is the exam trap. The question explicitly says that semi-variable costs step up at certain levels. They jump by 10% when you're between 85 and 95% activity, and they jump by 20% if you go above 95%. This means you absolutely cannot just prorate that initial cost. You have to follow these specific rules. This is where the marks are won or lost.
And boom, here's the final answer. Let's look at that semi-variable line. At 80% capacity, no change. It's still the base of 1,200. But look at 90%. We're in that first step-up zone, so we add 10%, bringing it to 1,320. Then, at 100%, we're in the second zone, so we add 20% to the base, making it 1,440. See? The variable costs are just the hours for each level multiplied by our 0.18 rate. And of course, fixed costs don't change at all. It's perfectly clear once you know the rule, no pro rata for step costs.
Awesome. So now you know how to build a single flexible budget. But let's zoom out. In a real company, it's not just one budget. It's a whole ecosystem of interconnected budgets called functional budgets. And all of them together create what we call the master budget.
Now, the king of all budgets is the sales budget. Everything starts here. Think of it like the first domino. Once you figure out how much you expect to sell, that decision sets off a chain reaction. It tells you how much you need to produce, right? That's your production budget. And that tells you how much material to buy, how many labor hours you'll need, and what your overheads will be. It all flows logically from that one single starting point, the sales forecast.
Okay, let's switch gears and talk about two advanced concepts that ICAI just loves to ask about in theory questions. These are performance budgeting and the famous zero-based budgeting, or ZBB.
So, performance budgeting completely flips the script. A traditional budget asks, how much money do we need? Performance budgeting asks, what are we trying to achieve with this money? It's all about the why. It connects the financial numbers to the actual work being done and the results being produced. It's less about just spending money and more about measuring what you get for it. And then you have ZBB, which is a total game changer. Traditional budgeting usually takes last year's budget and just adds or subtracts a little. The problem? If there was waste last year, it just gets carried forward. ZBB says, nope, we start from scratch. Every single year, every department starts with a budget of zero. They have to justify every single rupee they want to spend, from the ground up. It forces everyone to ask, do we really need this? Which is an amazing way to find and cut out waste.
Okay, it's crunch time. We've covered the traps, we've walked through a practical problem, and we've nailed down the key terms. Now it's time to put all that knowledge to the test with some actual exam-style questions right from the ICAI material. Let's see what you've got.
Here's a classic MCQ for you. Who is usually in charge of the entire budget control organization? Is it the general manager, the accountant, or is there a specific role like a budget director or controller? Think about it for a second.
And the correct answer is B, the budget director or budget controller. And this is important. While others are involved, there's usually one senior person whose entire job is to coordinate this whole complex process. It's a dedicated role, and that's a key thing to remember about how this is structured in a large organization.
And here's a quick exam hack for your theory questions. The ICAI material literally tells you where to find the answers. If a question asks you to distinguish between fixed and flexible budgets, you know to base your answer on Para 8.1. If it asks for the features of a budget manual, you go straight to Para 7. Use these references as a guide to structure your answers perfectly.
Now let's wrap up with one final, really important idea. It comes from an MCQ, and the statement is this: a favorable budget variance does not necessarily indicate efficient performance. Think about that. Just because you spent less money than you planned doesn't automatically mean you did a good job.
And that leads me to my final question for you. I want you to really think about this. Why could a favorable variance, say you saved a bunch of money by skipping routine machine maintenance, actually be a terrible, terrible sign for the company's future? It makes this month's numbers look great, but what disaster could you be setting up for down the road? Understanding this is what takes you from just passing the exam to actually thinking like a chartered accountant. All the best with your studies.